I was asked to briefly talk about the consulting experience from our side of the table. Who the heck is this guy sitting up in the room? Name again, Tim Burdick. I'm a senior consultant here at Marquette. I currently oversee our outsourced CIO business as well as our high net worth business. Over the past 17 years at Marquette, I have worked with pretty much all client types that we have here, both within the organization and represented in the room. And if you look up at the screen, a bit of age discrimination, research found the oldest picture of me that they could find. I do blame the gray hair on the financial crisis, not family. My agenda is pretty straightforward. I'm just going to follow through really the investment process. A few stories, a few anecdotal information, a few opinions, and just, again, very briefly kind of tell you from our side of the table what we see. In terms of client committee meetings, trustee meetings, we did some math. I have been part of, participated, led more than 2,000 investment meetings. No, I didn't think that hard about it when I chose this career, that I was basically going to be either in a car or sitting in a meeting. But that's essentially, as a consultant, what you do most of the time. Yes, I have seen most everything. I did recently have a gentleman fall asleep on me. Everyone falls asleep at a meeting at some point, after lunch especially. This gentleman asked me a question. He was sitting right next to me, fell asleep while I was answering his question, woke up and asked me the same question again. Everybody else in the room sat there and just let me answer the question twice, and then we went on with the meeting. So, yes, I've seen a lot. The point I wanted to make, the real point I wanted to make with client meetings is we have clients who have 1 or 2 meetings a year, a lot that have 4, maybe 5 meetings a year, and then we have some clients that meet monthly, and I've been through all of that. The clients that meet once or twice a year, I would recommend meeting more frequently, even if it's a conference call. This is where you build the institutional knowledge about your investment portfolio. This is when you learn more about your managers. Frankly, it's during the good times, like now. We come in through August, your portfolio is up 8, 9, 10%. Meetings tend to go pretty quickly, but you're learning about your investments as you go through this, so that when the tough times come, and they will at some point, I know we haven't made any predictions here, and that's good, but at some point we will have a downturn in the markets. Meetings become more tense, more stressful. The more the committee has had a chance to meet and talk and explain and understand their portfolio, frankly, I think you make better decisions at those stress points. There is a limit to this. For those of you who meet and discuss investments on a monthly basis, I have also come to learn over the years that there's some micromanagement can take place. When you talk about underperforming manager each month, month after month, you've talked about them for the last 6 meetings, it's only 2 quarters of underperformance. When you meet that often, sometimes some micromanagement can come in. The most boring thing we do is maintain your investment policies. It's also one of the main things that keeps an institutional investor, everyone in the room, makes them better than individual investors, everyone in the room. Institutional investors on average earn almost double what individual investors earn over time. That's not anecdotal, that's information, that's factual. One of the biggest reasons is that we have investment policies, and in times of stress we follow them. Almost all the time. I did have a client back in 2008. It's the fall of 2008, so take your mind back to that horrible period. We're in the midst of the financial crisis. I had a client with a $400 million long-term operating portfolio who came to me and said they want to go to cash. I'm a fiduciary in the portfolio. Marquette's a fiduciary. I said, no. We talked about it. They came back and they said, no, we really want you to say yes. We need the consultant's authority or the consultant's agreement to take this entire portfolio to cash. I went back to the partner, said, guys, if I don't do this, we're going to get fired. We went back and said no. They fired us in November 2008. They took the entire portfolio to cash. They asked staff to keep track of how much they gained by trading the market, by timing this thing. Well, obviously it worked for the first few months. The market bottomed out March 2008, started to go back up. Once they had lost $80 million, they told staff to no longer track their gain. They hadn't gone back in yet, because again, to time a market, you have to know when to go out and when to come back in. But frankly, just by not sticking to their policy, by acting like a retail investor versus an institutional investor, think about how much money, that 80 was just when they stopped calculating how much money they really lost by doing something like that. So again, investment policy it's boring, but it's important. And again, understand it, keep track of it, make sure it's up to date now, such that when bad times hit, you've got that to fall back on. Importance of asset allocation. If you are a new client to Marquette in the last half dozen years, you've seen this in our pitch book. We are top-down investors. We look at asset allocation before investment managers. Why? Because it's the most important decision. Long-term, 90% of your return comes from the asset allocation decisions that you make. They've done so many studies on this that they've pretty much stopped doing studies on this. Now, how do you spend your time in your committee meetings? Do you spend 90% of your time talking about asset allocation, looking at new asset classes, exploring risks and benefits of each? No, we tend to spend more time talking about the investment managers, having them come in, yell at them when they're underperforming. Frankly, again, a recommendation, look back at your next meeting, next couple of meetings, look at the agenda and look at how much time you're spending on asset allocation, what else you could do in that front. Push us as consultants to do that because it's important. When we're looking at asset classes, and both of the client examples I'm going to use here are actually in the room, so I'm not going to point them out to protect the innocent, but you expect us to give you an educated answer regarding an asset class. And my example here was gold. I had a client, I got a heads up that the chairman wanted to put 10% of the portfolio into gold at the meeting next week. This is back in 2010. I think gold as an asset class is about 2 steps above baseball cards. Actually, 2 steps above Bitcoin. We're not doing 10% in gold. But getting the heads up allowed me to put together materials, work with research, go back to them, and give them basically an educated no. We as consultants are very happy, very respectful when you do the same for us. When we come in and say, do an asset allocation, say we want to invest in hedge funds. We want you to explore that asset class. Well, no, I just read something in the Wall Street Journal about hedge funds, so I don't want to do it. And I'm not advocating hedge funds, I'm just using this as an example here. Or Kramer told me on TV not to invest in hedge funds. What we would prefer is that you go through the process. And there's a client here that it's 10 years ago, did an asset allocation, said, we want you to explore the asset class. They spent the next 3 meetings looking at asset allocation study, looking at a manager search. They interviewed a couple of managers. They came to me at the end and said, we're not going to invest in hedge funds. Very specifically because we don't want to bet in other companies and other people's failures, shorting stocks. We don't want to benefit as an organization when a company's stock price goes down. That's not who we are. That to me is an educated no. That means they understood what shorting stocks were, but they also understood the process behind it, and they took the time and they gave me an answer. That I can work with. They're still not in hedge funds, and that's perfectly fine because they gave me a viable reason why. It wasn't because of an article they pulled out of the journal the day before. Why rebalance? This is something obviously happens quite often in your meetings. Right now it's really easy. We come to you, we say we want to take $1 million out of the stock market, put it in bonds, you guys are fine with it. Stock market's overvalued, things are good. It's much more difficult to get you to rebalance when things are bad. When this market is overvalued, it's very logical to pull money out. I'm not a gambler, well, I'm kind of a gambler, but when you're up at a table, you can take one of those black chips, put it in your pocket, you take some gains off the table. People understand that. It's much more difficult to get clients to rebalance when the market's going down, 2002, 2008. I have an example. I had a client, went to them February 2009. Remember, this is the bottom of the financial crisis. This is the worst. $70 million portfolio, I wanted to take $1 million from short-term bonds, put it back in the stock market. Because of their investment policy, they were under their minimum in equities, wanted to follow the policy and go back in. They looked at me like I had 2 heads. I think they yelled at me, and they said no. Forward 3 months later, so this is meetings in late May 2009, the market had started to recover, came back in, said, guys, I want to invest $1 million back in the stock market. They were feeling a little bit better. They said yes. That decision of waiting 3 months cost them $500,000 so far. And that's on $1 million. By waiting until it felt better to rebalance, again, they were out of policy both meetings, but because they waited just 3 months, just 1 meeting, compounding interest, compounding over time, they are down about $500,000. No, I don't bring that up to them anymore. That's not good consulting. I get thrown out of the room. If you want to fire an investment manager, again, we've talked now asset allocation, we've gone through the meetings, we looked at the policy, now we're at the page where we look at your investment returns, and you're going down the year-to-date column and looking at how your managers are doing, and you're saying, well, should we fire this manager? My clients are tired of me saying this, but my initial general reaction is, would you hire this manager today, given everything you know about them? If you hired them in years past, because let's face it, they have a good policy, they have a good team, they've got a good process, good organization, they stick to their guns, they don't drift or they don't do something like that, but their short-term performance is underwhelming. This is generally not a good reason to terminate an investment manager, but it's the reason that comes up most often. We come to you if we find out there's something happening organizationally. Generally, you come to us when their short-term performance is lacking. Have an example, a manager probably, well, most of you probably know, some of you use, we've used them for a long time, Dodge & Cox International Equity. This is probably the best example of this. Last year, mid-year, so the box on the left, the one-year return was 8% or 800 basis points below their index. Really good shop. A lot of our clients have been with them for a long time. When you miss by 8%, we get questions. David Hernandez, who just spoke, is part of the international equity team. He spent a lot of work on them, a lot of time on them. Again, same process, same people, same organization. Obviously, I wouldn't use it as an example if it didn't turn around and work well. The next 12 months, they've outperformed by a full 10%, 30 versus 20. Again, short-term performance is generally the worst way to evaluate whether to keep a manager or not. Go back to the process and the thought process generally behind why you hired the manager. Finally, all of us as consultants, emails, texts, phone calls, before the meeting, after the meeting, Tim, I heard about this. Should I invest in this? I want you to ask yourself 3 questions. Anytime anybody comes to you with an investment idea, let's say Bitcoin. First, is this idea coming from someone who knows what they're talking about? I don't know how to fix a car. I will ruin your house if I install your faucet. And listen to people, investments, who know, frankly, about investments. It sounds basic, but so often we get articles forwarded to us from a local paper. I heard this on TV, these ideas. Bitcoin is a fantastic example of that. Gold was an example back in 2010. You can't tell me how you value gold, but they said, well, somebody said I should invest in gold, so should we invest in gold? First of all, who's that information coming from? Second of all, are they trying to sell you something? This community is outstanding at marketing. We can make anything sound good. We really can. I mean, there's a lot of money floating around. There is a lot of opportunity. You can really, I've told this to clients, you give me any idea and enough time, and I can find data to support that idea, however idiotic it is, because there's just simply so much data in our universe. Most people who have a product to sell want to sell it to you. That's their career. So generally not great to take investment advice from somebody who's specifically trying to sell you something. It's also not great to take advice from someone who has ratings or has clicks on the internet or is trying to sell you subscriptions. Kramer is not there, what's his tagline, to educate and inform? It is not. He is there, or educate and entertain. He is there to entertain you. That's how he stays in business. So generally, don't take investment advice from someone who is to entertain you. If the answers to these questions are as follows, if it's coming from a reputable source, they don't have anything to sell you, and it's not something you heard on TV or on the radio or something dynamic that they're just trying to get you to listen to them, bring those ideas to us. Some of our better ideas, some of our better managers over the 17 years I've been at Marquette have come from some of this. And we'll take it, we'll explore it, we'll find out. And again, you can come to us with all the questions. I'm sure we're going to get some Bitcoin questions at our next set of client meetings, and somebody's going to come and razz me about gold. That's perfectly fine. But let's take the time to understand what we're doing, bring those ideas to us, figure out where you're getting this information from, and move forward. Thank you.